Hi guys, welcome back to the Corrective Strategy course. In today's video, I want to talk about something that is imperative for every corrective trader and every trader, albeit, and that is having a checklist when we're trading. Now, I know some people have been getting confused sometimes with the rules, so I wanted to make everything super duper clear and help you guys as well formulate that checklist that we are using when looking for the setups. Now, obviously, everyone's welcome to customize their own trading checklist, whatever works for them, incorporate their own trading strategy or their own signals that they use into this. I don't have a problem with that. I'm just giving you a very basic but a very solid foundation to work with going forward. Here we have a basic 4-step checklist. First of all, number one, sharp impulse, which is one of the key things in identifying the trade. We want to make sure we're looking at those impulses. We're looking for those moves that have above average candles in there. Could be one big candle, could be 3 big candles, could be some continuous, but it's a strong move. It's happening in a shorter period of time. And we can go through that on a chart as well after this. And we want to look to the surrounding range as well. So it could be a big candle, but if all the candles are big around it, then it might not actually be that big relatively. So we want to look at the range surrounding the impulse and make sure it is an actual good impulse. Secondly, we want to use the retracements to determine where the entry and the risk reward are. So in the previous video, I talked about the variations of the setup, whether it retraces 30.9, 38.2 or 50. That's going to determine where our entry is, where our exit. Well, the exit's always above the 38.2 extension, and it's going to determine the risk reward of the trade. Each trade has varying risk reward. Number 3, we want to enter in an area of liquidity, an area of interest. Going to talk about that in a bit more detail in a moment. But yeah, looking for either an area of liquidity ideally is where our entry is going to be, or there's going to be an area of liquidity sort of protecting our stop. So we might get in before the high, we might be selling before the high, but our stop needs to be above that area of interest to give us that bit of protection. Typically the trades that don't work out are the ones which don't have that kind of area of interest we're getting into early, and we're getting in the middle of a range or something like that. Those trades tend not to work out. Sometimes they do work, which when we're doing our back testing, we go, should I take it, should I not? But if we want to be selective and we want to have those high quality trades, it's better to have your entry in that area of interest. Then lastly, we want to have a confirmation signal on every trade. We want to have something extra, and that could be any analysis you have, any indicator you use. But I like to use divergence, as I talked about, support and resistance, other levels there. It could also be like things like pattern recognition, which I'm also going to talk about, the various different types of setups that we get in the strategy. We can use volume profile to determine support and resistance. We can use VWAP as well as another sort of support and resistance, or as a magnet to the market. We've got pivot points as well, but there are many other tools out there. The more we have, the better. I'm saying 1 confirmation minimum. If you've got 3 confirmations, then that's ideal on a trade. But if you're going to set yourself that rule, then you're not going to get as many trades. So keep that in mind. This is a big one. Avoiding these trades in the middle of the range. As you can see here, this was a nice impulse. This retraced. It wasn't the best sort of pattern. It did happen a bit quickly, to be honest. We didn't get that sort of double bottom. We didn't get a bounce or 2 points formed. It was only really 1 point, and then it just broke down. But nonetheless, this is an example of, entering in the middle of a range, not really ideal. You're going to get stopped out. It would be better on the second one, entering down here, where you've at least got that level of liquidity there. You actually got a level. Entering in the middle of the range, sometimes it works, sometimes you have those sort of swings, but unless you've got a load of other confirmations, maybe you've got 2 or 3 confirmations and you've got a nice pattern here, I'd say avoid those trades in general. Avoid the middle of the range. I think that's a big one for the corrective strategy that will help you avoid it. Just going on to the next one, I want to talk about day trading. Now, day trading, if you're a day trader, in general is harder. It's a much more competitive environment. You're up against more, high frequency algos, banks, the best traders in the world, proprietary trading firms, etc. So if we are going to day trade, we need to be aware of other things, and we need as many things in our arsenal to ensure that we can be competitive in this market, and we're not just sort of just ticking away and trying to catch trades without putting a bit of work in. So obviously, first of all, you want to make sure you're being active in times of liquidity. I think liquidity is quite important with this strategy because in times when the market has less liquidity, if you're trading short term, that's when the market can easily blow out, and that's when the market can overextend and can squeeze you out of the trade and go a bit further than that 38.2 extension. So being aware of the sessions, very important. London Open, great time to often spot those day trades, or US Open. They're the two key points. I say avoid the Asian session. It's just generally not good for this strategy. It's not good for day trading. If you are in the States, I know that can be a little bit frustrating because some of you might have schedules where you're available during the Asian session, but not so much in the London, in which case it might be better for you to just be more of a swing trader, looking at 1 hour as your lowest time frame and going up to 4 hour can be good. So yeah, avoid Asian session, avoid entries after 4:30 London for day trades, just because nothing good comes up after that. Really, you don't want to avoid that. Also avoid, obviously late Friday as well. Bank holidays, not good. Low liquidity, just avoid it. Just don't bother trading. Same with Mondays, I'd say, from my experience. As much as I want to trade on Monday, it's been the weekend and I'm keen to trade. It's easy to get tempted back into trades and take them on a Monday, but they just turn out not to be that good, really. There's never really news on a Monday. Monday normally has that false move. The liquidity is not there, the interest is not there. People are just sort of watching, waiting to see what the week holds, waiting for Tuesday or Wednesday or Thursday data or news. So as a day trader, I'd say you leave Monday, take it off. Use that to do something else productive, like back test or fill in your journal, get your journal ready for the week. Go through your journal for previous trades, do some reviewing. Keep an eye on the market by all means, have a look. But be aware that you might get tempted into trades. I'd just say, from my experience, it's better to leave Monday as a day trader. Pivots are a great tool, as I've alluded to in another video. They are a great tool to sort of manage the expectations of the day. If it breaks a certain pivot level early morning, then you can expect it's going to go to R1, R2 or S1, S2. If it's breaking S1 before New York, you can expect the range might even go to S3 by the end of the day, depending on if you've got news and things like that. Pivots can kind of help you anticipate where the day is and where we are going, and can give us a bit more of that sort of clarity. They can also act as great sort of day trading levels, reversal levels. It can, spike up. If you have a downtrend on the daily, and then we're looking at, as a day trader, at a pivot level, and then we see before that London Open, we're swinging up to that level. Sometimes there can be a corrective setup or something in there. It can act as a good sort of trade. So yeah, looking at high time frame trends as well can be helpful as a day trader. Keep in mind where the direction is. That can sometimes help us get some of those bigger moves. And then we got, order flow indicators. You've got session volume, VWAP, support and resistance. All of this I'll do some videos on as well. I've touched on them a little bit before in the past, but I think can also be helpful to look at and just give you those extra confirmations, extra confidences. Now, as a swing trader, it's a little bit less complex. We're not as much in the war zone as swing traders. We can kind of sit back. We're not as much, because we're looking to hold overnight. We don't mind holding overnight. We don't need to be as hands-on with everything. We don't need to care so much about time frames and the sessions. So that would be looking at 1 hour, 4 hour daily setups, and these can be better for newer traders, a bit less stressful, take a bit more time for the trade and the entry, and you don't need to worry so much about all these finer details. Swing trading, still great, still works great with this strategy. There will be less setups, of course. If you're a patient person, then this can be good for you. But yeah, same checklist. You need the same structure. We need a confirmation. We need still that same 4-step process. Now, I wanted to, before we just freestyle and start using the checklist on the charts, I wanted to just talk about structure as well, just to help some of you out. And what are typically the good types of corrective setups which we can rank as our best ones, the ones that work well. Start with the first one. This is kind of our bread and butter setup that we are going to be trading. This is rough outline, but what we are looking at here is that kind of classic W setup. We have that impulse, we have that move, it kind of rounds a bit, it goes up to that rejection pretty quickly, and then it comes back down. This is a bread and butter corrective trade that we like to take. It's not the best one, it's not the worst one, it's just a standard corrective setup that I like to trade. I see it, and we have some nice sort of levels in here, and we have confirmation. Then I like to go for that. Next up, we have the standard kind of double top. Of course, guys, everything I'm drawing right now, this you could apply the reverse. You can apply the reverse of that, no issue. So this one in reverse, just to show what I mean, would be the same as having a double bottom being formed and then having it broken and coming back. These are nice examples. They are great trades. They're slightly better than the first standard kind of W setup. This is more of a more defined W. Well, this is the first one. Sorry, is more of an M, and then this one is the second one is a W, which I say is a slightly better setup. You're having a range being formed either side, which allows for this kind of this double fake out trade that catches people out. That's kind of what we're trading. People get faked out on the upside, breaks out. Some people go long, thinking it's going to go higher. Then it comes and fakes out on the other side, and then these people get stopped out. These people get roped into a new trade, and then it can do anything from here. It can either collapse or go higher or just swing about in the range. But we're just capturing that volatility. Double top, double bottom, great trades. You know, obviously retail, when they see these type of trades, they are taught to, you know, buy the neckline and continuation. It's meant to be this kind of setup, reversal setup. We're doing the opposite of retail on these trades, so it's another good setup. This is another great one, which is on par with the W, I'd say, is that rising flag kind of setup. The more of these kind of ranges that are formed, or this tight trading that we get in markets, once it breaks, you normally have that sort of explosive move, and then it will come back down to that initial retracement level. Now, we're marking our levels each time to make sure that we are getting the entry that we need. I've not drawn this exactly, I've just drawn it with the eye. I haven't drawn it based on fibs, but this is 30 spot 9, so our entry would be somewhere in here on the 236 in this example. We would be trading it down to the low of that. Again, yeah, these are great ones. I love these kind of rising flags, or if it was the reverse, it'd be a kind of falling flag. Just a great standard retail setup that we can watch. Yeah, once this line is broken, you usually have a nice move, a nice collapse once it kind of does that breakout. So having those tightening of ranges are nice to look for when we're looking for the setup. These ones are great. One of my favorites is kind of having these distribution or accumulation setups where you have these kind of bigger ranges being formed, and you're having these continual touches on highs. You know, sometimes they look a bit. They look like multiple W's, and they're kind of taking each side out a little bit, and this building up this kind of pressure, in this case selling pressure, until it eventually does what Wyckoff calls the up thrust, and then we have that breakdown. But this leg should be a bit longer, but anyway, you get the picture. These kind of Wyckoff distribution, or the reverse. The reverse can be accumulation setup, having that impulse, then having this kind of build up of pressure that's kind of testing the market for a long time. Eventually it will do the corrective move, something like this. These are great setups, one of my favorites, the accumulation and distribution. Don't come around as often, but when they do, they are fantastic trades. So yeah, guys, these are the 4 kind of main setups. Our bread and butter being this kind of simple, straightforward. Take the highs out, then come back below. The others have a bit more structure, ranges being formed. These things that we like to look for, a range being formed, or some kind of wedge being formed, or some kind of accumulation distribution being formed. They are the perfect type of correctives that we're looking for out there. Just want to say, for day traders, you want to be wary of these kind of things happening. So often, sometimes we'll look to identify a trade intraday. We'll look to have these we'll see this spike happen, we'll see this retracement, and then it quickly goes, and then we think, okay, we'll sell quickly, and then it continues higher. Now, you need to be aware of this. If we identify the impulses too quickly, then we risk this actually not being the impulse, and this whole move here, in reality, could just be a impulse on a higher time frame. So if this is happening on the 5 minute, this could be the 15 or 30 minute, and then after an hour's time, it actually turns out that this move here was just this, and we got in too early, and then it's actually going to do a corrective on this time frame. So just be aware of that when you're on low time frames. Let the structure form, let it move. I know it can be difficult sometimes. News is flying around and we want to get in, but if you are going to take these kind of trades, make sure the structure is good and the areas are perfect and you've got these confirmations. Otherwise, just let it form. If you miss it, you miss it, but many times it's better to just wait for a trade to form rather than trying to preempt it too quickly. I see that as a thing for some corrective traders as well, is rushing for the trade. It's better to let it form and let it show itself, reveal itself as being the setup. So let's just run through a couple examples on a chart just to look at the checklist in detail. Okay, so we've got one here. Let's take a look. So we had a good one on EuroCAD. Step one, we have an impulse, this move. You know, we've got a big candle here, much bigger than surrounding candles. Then we have a couple more decent sized candles. This is the impulse, high to low, and we can measure that out after we establish that. Then we have this retrace 30.2. Okay, step two, we know that if it retraces 30.2, then we need to look for a standard entry at the rejection level. So around about there. And our target is back at that high. Now the trade did go a little bit offside here, but just touched that next level. Our stop would have been below here, and we would have got out of the trade in profit. So that's a good example using the checklist. Did we have any other confirmations? Area liquidity was here. Okay, in this example, our entry wasn't in the area liquidity, but our stop would have been below it. So it's okay in this example. We're entering near the bottom of a range. We're not entering in the middle of a range. You know, we're pretty close to the lows here. Divergence. Did we have a divergence? Yes, we did, from here to here. So there we are. Perfect trade using the checklist. We established the impulse. We established the retracement. So we established where our entry and exit are. We established that there was a liquidity area here and our stop was below it. And we then got a confirmation with divergence. We could have looked at other things such as VWAP. We could have looked at session volume. If we wanted a volume indicator. Intraday. Is it showing? See, at the time, using the volume profile, we could have used this information that this move was happening on low volume, which indicates there's a kind of a spike occurring. So it's a low volume move. As I said before, typically we're capturing low volume moves, and when the corrective setup is happening, that's why we're catching these wicks, we're catching these extremes, because price hits a point when it reverses. People don't want to trade at that prices, and then in this example, not many sellers want to sell down here, and the buyers start buying higher and sellers start pulling their orders, and it flies back the other way. Sometimes this POC level, point of control, acts as a kind of support and resistance or area of interest. But yeah, these are just little confirmations we could have used. Apart from the volume, we Could have used other confirmations, like looked for some support and resistance. Have a bit of a level here where our rejection level is. Could have marked that out. A bit of a level here at that low where we were buying, which acts as support. We can see here 1, 2. So there's an extra confluence that we had here. And there's many other things we can look at. We all know technical analysis, there's multiple tools we can use. So yeah, that's an example. Could try find some other ones. As for structure, this was a standard kind of M pattern. Nothing too exotic, but it had everything else. So we don't mind it. This is just standard bang, bang, bang. Bit of an M. Again, this is a standard one. We've established strong impulse, 30.9 retrace, so we need an entry here, and then we want to get out back up here. Again, that's another standard in terms of structure, but we have got a nice liquidity level there. That we're entering underneath, which is pretty ideal. We're entering in a liquidity zone. Do we have any other levels down here we could look at? Yeah, nothing too. This is a little zone down here, so we're sort of entering on this level. Nothing too relevant. Did we have any divergence? Yes, we did. We had a nice divergence. So there we are. We have a setup. We have entry in the liquidity area. We've established the impulse is good. We've established the risk to reward with this. Then we got confirmation at least with the RSI, which made it a nice trade. This is one, but it probably doesn't make the cut, as we can see. Retraced here. I mean, this is like one of those ones that are kind of like 50-50, where it's like, should we take it or not? It retraced 30.9, so our entry would have been here, and we would have got out nicely. This is like one of those quick ones, but we have got that nice sort of rising wedge occurring here. You can kind of see what I mean. Got this kind of little rising wedge occurring, and then it breaks down. Other than that, it's not. We haven't got any confirmation from RSI. You know, continue the rising wedge. No divergence there really. Not even from this point to this point on here. We can use sometimes like a fib swing to see if there's any extra divergence. So you could take this swing to this swing. We could say, okay, we've got the 78.6 our 38.2 levels, so that's kind of protecting us. We put a stop there. Entry is not in a liquidity area, really. There's no liquidity area. The liquidity area is here, so not that ideal. You know, you've got some levels sort of here where it was. Got a bit of a support there. It's kind of at that level. Also at this level there's a bit of a, but yeah, as you can see, this is a bit iffy. This one it worked, but impulse isn't great. We don't have a divergence, we don't have a liquidity area. There's that many things that are not looking iffy. It's better on the whole to just leave the trade. If this was a slightly stronger impulse, I mean, the impulse just about makes the cut in my opinion. You've got 3 decent candles, but nothing. This big one in the middle is the only really big one. The other ones are sort of average. If you look at the surrounding area, if the impulse was a little bit better and we had a divergence, I'd say take the trade, despite the fact there's not a liquidity area, because at least we have this kind of Fibonacci swing on the trade that we can look at that will usually act as some kind of support, and we have a ranging sort of market going on here. There are wicks and stuff going on in the area, so there can be these volatile swings that we can trade off. But yeah, if it had a couple of extra things going for it, this could be a trade, but I'd say based on the checklist, it doesn't make the cut. Yeah, so this is more like it. This is impulse, 50%, so our entry should be at the CT level, the 236. So we would have got filled on the second spike up, and we would have got filled here, and then we would have been targeting low. We had a nice risk reward on that. I don't know why it doesn't want to stick to that red line, but that's where the entry would be on that red line, and we would be out there. So this is a nice one, a nice kind of range, one of those sort of rangy setups that I'm talking about that are really wide. Those ones generally work pretty well when you have a wider range. Fake out becomes more likely, and we could trade that fake out. So yeah, those are normally quite good ones to trade. Did it also have a divergence on there? It did the first time. By that point, we would have put our order before anyway, but the second one didn't have a divergence, but it's okay. Are we at we've got a level here marked out from a higher time frame. We've also got this level occurring here. The structure or the pattern of the trade itself can also be an extra confirmation. We can use it as a confirmation if there's a nice kind of pattern occurring, like the ones I spoke about, that also adds weight to the trade. Often my brain is identifying the setup by the shape of the pattern and how it looks. This is example, guys, of how we are filtering trades, looking at that checklist, looking for those key things that we can use. I'm going to go more in detail on some of the other tools we can use and go more in detail on day trading in separate videos. But I hope this is useful. Any questions, of course, get me in the Discord. We will talk about it, we'll discuss it. Have a successful trading day, trading week, and look forward to discussing more with you in the community. Thank you.